Cool. All right, so today I want to kind of start to put things together. We've had this little crash course series and went through really quickly kind of the different key elements that I think are what's important to take out of, ICT or SMC, whatever you want to call it. And today I want to go through just kind of how to use them together. And sometimes this can be discretionary, sometimes it can be mechanical. I recommend for people that are still learning it to try to keep things mechanical. And, when I say mechanical, I mean a very, very solid if-then process where, you only trade through fair value gaps or whatever it is your strategy. I'm not saying that should be your strategy, but once you pick a strategy, I wait for a liquidity raid during the AM session, and, I need displacement in a fair value gap to get, to get long, and it has to be at a discount of maybe this range here. And if you don't get that, then you don't trade. Discretionary would mean that maybe, okay, well, I've traded this strategy enough to know that, I might not get the extra, couple pips or better risk to reward, but, I'm willing to maybe move my stop loss up to the bottom of the fair value gap or different things based on, how confident you are in your bias, how confident you are in the displacement of the range that just was broken. And there's a lot of different things that once you get used to the market, you're going to be able to navigate a little bit more freely. But you still need to have somewhat of an if-then process. You can't ever just have no trading plan. But with time in the market, especially trading the stock market, like the futures market, there can be a lot of discretion that can help, and I've seen that a lot recently. So the main elements that I want you to focus on are really daily bias. Which way do you think that the morning or the afternoon session, whatever you're trading, which way do you think it's going to go? What is the structure telling you? And when I say structure, remember that displacement is required for, like, anytime I look at structure, it has to be displacement or it's not structure in my book. If you guys haven't watched that video, I put out a couple videos on structure, but the one on YouTube is really good about kind of explaining my thought process on how to identify what is structure and what's not. Because not every high and low to me is going to be solid structure. A lot of it's just liquidity raids. A lot of it is just noise that you don't need to pay attention to. You want to pay attention to what kind of sponsor or what kind of structure is sponsored by, big players and big moves. And then we want to just look at, liquidity for targets. What is price moving towards, aka draw on liquidity. And both of these kind of go hand in hand, but they are a little different in my opinion as far as understanding what kind of liquidity you can target doesn't always have to be your, full draw on liquidity. So we'll just look at the recent price action on the micro NQ. And I'm going to go over kind of the trading I did yesterday and why I was looking for what I was looking for. So if we come into the market, and obviously we know now, I posted in the Discord some of these with executions, and you guys are ready to see in a second. So it's not just hindsight. You're able to actually see, that I was trading this. So the idea that I had was, first you want to develop your bias. So for instance, if we look at the most recent displacement, right? A lot of people mess up and say it's this right here, because I guess, you can look, I could see that, okay, well, we came up and displaced, but you got to ask yourself, what was the context of that? What's the actual range we're playing in, the local impulse range? You could mark it as this to this right here, or this to this, whichever one. Whichever one you marked, the absolute highest high to the low, or where the displacement started, I recommend doing this because this is going to give you more of a current dealing range. And again, we're looking at structure that shows institutional involvement. To me, all of this in here was just kind of consolidation, or accumulation of orders before we get manipulated. So I'm not going to pay attention to all this as much. I want to see where the big move started. All right, so right there and right there. So then you ask yourself, okay, within that range, what is the context that we're trading within? So when I look at this coming into any of these days here, the context I see is that price is bearish. We traded into price delivery raise in a premium. We took out liquidity that was resting below a premium, and we showed a desire to move away from that. So in this, the expectation is we're going to take out this low. Don't overcomplicate it. I mean, it's just, that might not always happen. Some people, oh, what about this fair value gap? Oh, what about this order block? But you got to remember, what's the context? The context is you're in a bearish market and you're expecting to continue bearish. And that doesn't always happen. And you can, pair that with like a weekly or, this would have given you even more context to be bearish because we're also in a premium of the weekly range traded into an order block. But you have to go with the expectation of what's going to continue. The market is mostly continuations. Something that I'm not a big FX fan, or I think that some of his stuff is good. And one of the best things that I like that he says is that the market is 90%. It's a lot. He said 90 or 80% continuations, whatever. But the gist of it is that the majority of the time the market is continuing. So you have to go with the expectation it's going to continue unless you have proper context to say otherwise. So in this, we didn't have any proper context to say, why would we go up? We just had a massive displacement structure break to the downside. We have a bearish range. We traveled to a premium and we moved aggressively away from it. Don't overcomplicate it, right? So at that point, your drawn liquidity is the low. Now, in this example, like let's say in just a flip side example, let's say if we had right here, and you say, okay, well, we had a nice displacement up, a lot of people get confused and say, why wouldn't you target this high? Because if you say that, you're on the flip side, we're targeting this low. But the reason for that is that this is a bearish range. So you have to understand what is the market doing? Is it retracing or is it expanding? This is retracing. We're just retracing a move. We're retracing a bearish move. So in a retracement, we expect us to go to a premium. We don't expect it to go to to the liquidity. We don't expect it to go out and take out all of these stops up here. Because the context, remember, is that if we're going down, we're going to continuously go down, right? We're not going to expect, if we're retracing, and these ranges, you're just expecting the market to go, right, I fucked that up, hold on. Sorry, my drawing skills are not the best, not Michelangelo. But the idea is you're just gonna retrace to a premium and then to continue. If otherwise you'd say the market was just gonna do this all the time. And sometimes you'll get that, but we don't always just take liquidity and liquidity, as far as external range. Remember, price is always gonna move from internal liquidity to external liquidity. I can type, and back to EQ. EQ as in 50%. So if you can understand this right here, and don't overcomplicate it, it's going to help you so much with bias. And this is the first thing you need to do whenever you're trying to determine, am I going to be more long or short bias today? So if we look at the market, like, okay, in this day, we're going to be retracing, and we're moving back to EQ. But again, we're going to move to internal liquidity to complete this process, right? So it goes internal liquidity to external liquidity to equilibrium back to internal liquidity. So for instance, here, where's the internal liquidity? Yeah, I wouldn't consider this a breaker because it didn't take stops. So you got a nice fair value gap, clean as day, right? You got a volume imbalance right there too. So you could say that in this day, the bias would have been bullish. So you're going to be looking for, other signs to get involved in the market on a bullish narrative. But again, whenever we come back into this, now, if you see a rejection, the market is going to be bearish. Now, we're not going to be looking just for this fair value gap. We're not going to be looking just for this order block. Now, those can be profit targets for intraday movements. You don't have to catch this, but the bias doesn't change until you've taken this out. And then after that, usually you're going to be gravitating towards some other point of interest before reversing, which could be this low, right? You could go down to 4 hour. Maybe there's order blocks in here, right? There's a pretty clean order block right there. So that could be a good draw on liquidity because you know that we've taken out this bearish range. We're looking for problem areas where we might see, the new low. Because if we look at this over here, like this low, where did the low of the last range form? Right under liquidity pool right there. So we just look at those areas as potential reversal zones. So this could be this order block, it could be this low. But until you meet something like that and get a shift in structure on the lower time frames, you're not going to look for that reversal and start being bullish again and look for that retracement. Now, how could you kind of, determine this a little sooner? Well, once price taps into these zones, you can scale into like a 4 hour or a 1 hour and just look for a break of structure displacement, just like we're confirming any zone. Right, and then just like you have this daily dealing zone, you've got a 4 hour dealing zone, right? You could say it's this right here. You could use the high to low, And again, you just see price moving, here again, it's on a smaller scale, price is retracing this range back into a premium. Where did it retrace to? The breaker. Right? So another way you can kind of accompany this with targeting is you can use a standard deviation of the move that gave you the raid, so to speak. So if you just, I recommend going on like a 1 hour time frame and really like dissecting it, because a lot of people just mark the whole zone, and you can with this one, but if you want to kind of like analyze the price actually, like, okay, well, price kind of moved up and then we see these wicks down. So you could either, you could just draw this whole zone, you could, or you could just draw something like this. That's kind of like the last move, because price went up, wick down, and that's really the move. You could do like a standard deviation here. And see how we moved very cleanly right at 2 standard deviations, and then right down to the 4th standard deviation. And you don't have to look at the exact thing, you just want to look at liquidity pools near it. So that can help you in your targeting, as far as like when to maybe switch bias or what the draw on liquidity is. But overall, you're just identifying, okay, the market is bearish because we tapped into a premium fair value gap. And then from there, we got a shift in structure down. So at that point, the only time you're bullish is to, rebalance these small ranges, right? And go to a 1 hour to get even cleaner view. So again, you're just looking at all of this. You're looking at, okay, where am I going to short? Where am I going to short? You're not looking at like, oh, we're going to take out the high. There's liquidity here. It's just people do that a lot because ICT just says like, oh, we take sell side, we go to buy side, which that's true on a small scale, but I think it confuses a lot of people. Now, what I like doing after I've defined that is looking for my structure. So if I'm day trading, I really like paying attention to 15-minute and 5-minute structure. I think it's it's immediate, and it's going to give you kind of like what you need to see right now to trade. So for instance, let's mark some times out here. So here's that's the open, right? I like trading. I used to trade a little bit more before the bell, like the 8:30, but now I kind of like just waiting. For one, it gives me more time to have my morning. For two, it refines my edge even a little more. So whenever I'm looking at this range, this structure range, and with the displacement, it's pretty clear to see, what's the most recent displacement here, right? If I'm looking at, where is going to be the most displacement? It's going to be this right here. Now, if I look back here, so that's a 5-minute range after the opening bell, right? That gives us that big range. But if I look back right at the opening bell, I took a trade that I'm about to go over. I looked at it like, okay, we have a massive range right here that's obviously very bearish. We're also very close to a liquidity pool right there. So that gave me a reason, and we've traded into these fair value gaps. You're not always going to see a perfect return to premium on like the lower time frames as much as like a higher time frame. But I looked at it like the opening bell, like we had a big rush after news. So anytime you have that, if you rush up into a bearish point of interest with news, that's a short. That's just that simple. So this is where it gets a little discretionary. So when I came into the market, I looked at it like, okay, we have NFP liquidity right here, right? So again, a bullish push during the news. That's just obvious to me. It's just too clean. Like, oh yeah, like any motherfucker that is going to buy off news, their stop loss is right there, right? And it would have been different. Maybe if we had bullish, sentiment from our analysis, maybe there would have been a bigger push up. Because I know some of you guys are like, oh, well, I've seen NFP go bullish and then the market rails. Yeah, that happens. But whenever the overall bias, remember, it goes bias, structure, liquidity. So again, in that order. So if the overall bias is bearish and the overall structure is bearish, I'm looking for sell side liquidity. It's just that simple. I'm not going to say, oh, we're pumping displacement up. I don't switch that. That's why it's important to focus on these first, and then you target liquidity according. Now, if the bias was bullish and the structure was bullish, you would look for buy side liquidity. I think I might have said buy side the first time. I was saying sell side. I think you guys understand that. You guys know I say things like I'll say like premium and discount backwards and shit. But anyways, so in this example, whenever I look at the market and I say, okay, here's my clear immediate draw on liquidity. It's not like where I think we're just going to reverse in the daily, but right now, like what are we pushing towards? It's pretty clear to me. You know, if the opening bell right here, we come up and we take out a high right there, right at the opening bell, 9:30, take out a high, and then you get displacement down. That tells me we're reaching for something. Like this right here, this pattern, this whole little thing right there, that tells me the market is reaching for something. Simple as that. Now, what is it reaching for? In this example, it's very easy. Again, that news liquidity that's driven by bias. So if I see something like that, I'm just looking to get short for a quick move. So I'm not going to wait for the order block up here. I'm going to look for the nearest area because we're right up on that drawn liquidity, which is this fair value gap. And as soon as price got into it, I marketed stops just above the candle, the fair value gap. Because in this example, first of all, it wasn't the craziest risk reward, but it's a trade model that I'm very confident in. I was very, very confident we were going to hit this drawn liquidity. Actually, a little bit more. I was drawing this extremely fast whenever I was trying to calculate, because I won't take it if it's like 0.5 or something stupid like that. But if it's like 1.4, 1.5, around that, I'll take it, because I know that this setup, I rarely loses. If I'm very confident what we're drawing to, and we're on a lower time frame, I've got a fat fair value gap right there, like it's going to hit that and it's going straight here because price is moving from one area of liquidity to the other. It's just ping-ponging around, right? So that was an easy trade because, again, I had already identified my bias, identified where the structure was going, not only on the higher time frames, but on the lower time frames. So yeah, the bell opens, liquidity is taken, displays a break of structure. I mean, this is smart money concepts at its finest. You look at the fair value gap that caused the displacement, you can put your stops even above the candle is what I like doing. Because in my book, not often are you going to see something like this where the price goes all the way up here to the wick and punts back down. It's just, usually it doesn't. It usually isn't even going to get above the midpoint of this fair value gap far. I've even considered testing a model where I put the stop loss just above here. And again, with these scalping strategies, it's important that you get a good stop loss placement because that can be a big difference. Like, for instance, that would have made this trade a much less profitable trade. If I'd done it here, it would have been a much more profitable trade. So those little differences do matter if you're trying to scalp and do like very quick in and out trades. Because to be honest, if you just hit that right there, 1.74, probably like 1.6 after fees and like market order slippage and stuff. But that's a good trade. Like, you can end the day on that. If you're trading a nice funded account, like this was on a personal on futures, but in micros, but still, if you're trading, you could just end your day on that. And you can see how really understanding how to dissect things and how to understand why price is doing what it's doing and where it's likely to go right now, it opens up a whole new world of opportunity when you're trading, because you don't have to necessarily wait for like a 4-hour swing structure to go to optimal trade entry into an order block and then wait for 3 time frame confirmations. Now, those trading strategies are fine and are very profitable, but I think that it's a little difficult to trade consistently on a professional level, only waiting for certain setups like that. That's just my experience. I'm sure other people disagree with that. So that was the first trade. Again, it's just bias, structure, and liquidity. So next trades weren't really until later in the day, and we missed a trade right here. I wanted to take a trade on, another thing too at these, like, it sucks because they're pretty hard to signal, just because, I mean, I have to enter the trade, I'm monitoring it. By the time that I enter a signal, it would probably be played out. Because if you can look, like for instance, this trade was, I think, 2 minutes long, and actually it was a little less because this candle was already started whenever the entry, so it's like instant almost. So, but that's why I want to share these in depth with you guys so you can try them out. I recommend trying them before, like, go back test them on Forex Replay or something before you start trying to do it with a live account, or do it with really small funds or a demo. But the reason I wanted to short here, the next one, because again, we're just looking at structure. So if I'm trying to scalp on the, if I've identified the daily's bearish, the 4 hours bearish, 15 minutes bearish, then I'm going like the 5 minute. And it's literally the point where, like, you can just scalp structure. Like, if we're making higher highs and lower highs and lower lows, I'm just looking at each one of these as trading ranges, and I can capitalize off each one and take profit at the bottom of it. I don't have to try to get the whole move. You know, I can just chip away, chip away, chip away. Right? And this will give you a little bit more opportunity. But again, I don't want to inspire people to overtrade because it's easy to do that. But the reason I like this right here is, you know, we had this range of structure, and I could have marked, you know, all of this right here afterwards. But really what I was looking at is the draw on liquidity from the higher time frame. Because again, we had that standard deviation that I deleted the thing, but I'll draw it again. This was really giving me my terminus target, which was down there. So that was where I was looking. I was like, okay, that's the draw on liquidity. That's where shorts get, you know, shaved off, and I wait. Because until there, and you're really confident in it, it's kind of like a free ride. Like, you're just like, where do I get in? Well, I know which way the river's flowing. I know we're going down towards this low. And the reason I didn't pick this low is because a lot of times I've just been burnt so many times. Like, if I have like this little pattern where price does, it'll have like a low, and it's this low right here took liquidity, and then we kind of move, and then we have like a low, and then we move really hard off this low. I just always target that one because I know there is liquidity there, and you never know if your bias is all the way right. I've seen price come under it, protect this low, and then just rock it. So, and I'm sure some of you guys have been trading for a while, know exactly what I mean with these little patterns. But what I was really looking at was, okay, you know, here was the most recent displacement structure. So if I'm looking at the whole external structure in the 5 minute, it's right here, right? Let me draw like a rectangle on it so you can, oh, fail. Right here. So like that right there was the displacement leg of external structure. But then, you know, once we come back up into a premium, right? We came, just like we were talking about the daily, came back into a premium, and we got a displacement down. Then I have a new leg of displacement structure. So again, all of it is still internal, and yes, it's internal structure. But if I'm in an external range that's bearish, I'm not going to only trade from up here. That's just me. I'm not going to only trade from like the optimal trade entry. And you know, that's a great strategy though. If you caught this move, right, and you traded here, and you traded down, that's a really good strategy, right? That's fire if you caught that. Maybe you put a stop different, maybe you use order book, whatever it was. But you know, I look at it like this is the most recent internal structure with displacement. Now, why didn't I say that this right here was displacement? Because that is not displacement to me. Or I'm sorry, why didn't I say this is structure? Because a lot of people have said like this was a leg of structure, and then from here down is structure. But I don't look like that. I like it. All of this is because there's a displacement. Right? This is where we started to move back up. So after lunch, we had another displacement down. So we have another range of structure. So at that point, I just said, okay, I want to see us come back up into this fair value gap that caused the break right there. Right? Because there's no fair value gap on this candle, but right here there is. So at that point, I set us a limit to go here, stops with that high, and just down to this draw on liquidity. But it just wasn't coming back. I was watching the 1 minute. Price came down. And this one, I missed a better entry than I wanted to. So whenever I still need to release this video. I have actually a really good video of like a live trade and just kind of like plotting order flow along the way. But I was looking at this fair value gap as an entry, right? I wanted to originally enter from there at the stop loss up because it would have been much better risk to reward. But again, we got to think of the draw on liquidity down here like a giant magnet, right? Both of these are going to be pulling price to them. So the closer you get to a magnet, you're not always going to like have this perfect price action because every time you get closer, it continues to grow. So if we're coming down here, we're just drawing to this magnet, you're not always going to get, you know, whatever you watched in educational videos, like, oh, well, it has to come back to fair value gap. The fuck it does. It's not always going to. So if you're very confident in it, for instance, if I'm confident this target's going to hit, and I'm also confident that price shouldn't go above this, then to me, as long as I can get risk to reward, I would rather get 1.5 R than get no R. Yeah, sure, I'd rather get that if that happens. But on these trade setups like this, where they have a high hit rate, you have to think practically. So at this point, when I saw the price went close to it, I thought right here I was wanting to go up, and then we started moving really aggressively down. Then I said, okay, I'm just going to go ahead and get in. All right, got in, trade went right to the TP. That was the structural TP from the 5 minute. Because remember, the whole draw on liquidity based off of the standard deviation from all the way up here was down farther. But we're still going to take into account the structure that we're using to trade, which is this low and this high. So whenever we start to draw down into that low, delete that, then we know that we still need to take some profits there, or all profits, especially in these little scalps. When price came down, made a fair value gap, right? Like right that, equal lows. Because a lot of people look at that as support. Price came right down to this level. That's another free short. That one I actually had time to do a limit. As soon as this candle closed like this, we had that fair value gap, limit order, stop at the top of it. Because again, you're right in front of this magnet that's just getting massively stronger the closer you get to it. You have no reason to trade past this fair value gap. If the drawn liquidity is truly like down here and price is just tumbling down to it, it's like that's where it's going. You don't have to trade premium every single time, but I know this can be a little confusing because there's a fine line between staying disciplined and, you know, waiting for price to come to premium. And if that's your strategy, then maybe this won't work for you. But and if you know, this is my learnings and my takeaways from doing this. So again, it's just bias, structure, and liquidity. We had our bias was bearish, our structure in the high time frames is bearish, our structure in the low time frames is bearish. So it's just, where do we get in? Right? You're just looking for displacement and fair value gaps that cause displacement, or breakers that took stops before the displacement. Order blocks are good too, but in the lower time frames, I really like breakers and fair value gaps more. That's just me. Higher time frames, I like order blocks. And I mean, I like the other two on higher time frames too. But and some assets trade differently. Like I just know that with NQ and ES, they trade better with breakers and fair value gaps in my experience, and liquidity pools. You know, like the Dow trades better with order blocks. That's why a lot of people that trade supply and demand love the Dow, because it trades better with that strategy. After that, I didn't take any trades. I was done. After that, at that point, I was just said, okay, that's enough for me. Because you can look, a lot of people like, oh, like I get 100R, but it's like, okay, whatever. First of all, no, you don't. Second of all, you know, okay, 1.7R, 1.5R, 1.3R, right? So that's over 4R in the same day, with no drawdown, being in a trade for a total of maybe 15 minutes. I don't know. That's fine with me. I don't know about you. That's totally fine with me. And again, I also like these for psychology because they're less time in the trade, they're high hit rates, so they're easy to execute, and it's more time efficient, because if you're like me and you have other stuff to do, it's a lot better to be able to just extract money really quickly. And I like this style of trading for futures, and of course swing trading. Like we swing trade the fuck out of crypto. We've been murdering it this year. I think we've had like 3 losses. GMX and then Bitcoin twice. Most everything else has killed it. Oh no, Rune was another loss. It was Rune. But we also had like 3 or 4 100% gains. You know, so swing. I'm not hating on swing trading, but I am saying for end of season like day trading, I think this is the best strategy for me. It's most consistent. So let me see if there's any questions. Let's see facts. First thing I see is that a bird just hit my fucking window and committed suicide. Scared the shit out of me. Hi asks, when I'm seeing the price is close to the drawn liquidity, the magnet becomes bigger. But if there is extreme OB before hitting the drawn liquidity, you will just ignore it and still long or short the price. Yes. Again, this goes back to the beginning. If I am very confident on the drawn liquidity and the market's displacing to it, and the market is expanding, then I'm not looking for price to raise. I'm looking for liquidity. If the market's retracing, that's what I'm looking for, like order blocks and stuff like that, and fair value gaps. But if the market is bearish, like if we have, you know, this kind of price action. So let's say the market is, this is our range, right? Let's say the market came down somewhere back over here, and this was our, you know, our range of what we're looking at from an external perspective. Then just get rid of this one. This one sucks. So that's our range. then if I'm retracing, because overall the expectation is we're going to go down here. That's where you're going to end up. So if I'm going up, then yeah, the draw on liquidity to me is probably going to be an order block or a fair value gap or something like that. So if you go up here and the market trades into something like that, that could be I draw on liquidity. But if I come down here and the market's expanding down, I'm not going to say, oh shit, there's an order block here. Like, fuck that order block. And I might be wrong. That's fine. But I just know in my experience, when the market's expanding, I'm looking for liquidity. You might get some kind of reaction to it. That's not to say you won't. And let's say if you have some massive, like, for instance, let's say price had just done something like this. This is going to be an ugly line, but just bear with me. Like, if you had some massive push down into it, then yeah, I'd say, okay, I don't think the market's just going to, continuously just go straight here. It could, but these are the times we'll say, okay, we've got a pretty big displacement range that we're in a discount of, and we just took out liquidity into a range. But if you have just, normal structure where we're getting, displacement down, displacement, and the market's, taking its normal course, and we do something like this, and we're displacing down, like, this tells me, like, that pattern, that displacement, return to, like, a fair value gap, and more displacement, that tells me that we're seeking liquidity. Now, again, it's all about context. That's why context is important, because you have to understand what's likely to happen. It doesn't mean that that's going to happen. It doesn't mean it's going to be perfect. But it means that if we're in an expansion and we're bearish and we've traveled to a premium, we're most likely to make a new low. Now, of course, there's the times where it does this and then just, has one of those. That's going to happen. So what's going to happen to most people who are worried about this happening all the time is they're going to be paralyzed right here. And they'll say, oh, we're in an order block. Do I got a long? Or do I got, close my short? You know what I mean? And then they're going to, and it's just not consistent. And what that comes from usually is not enough confidence in your bias, or not being okay with taking a loss or being wrong. And that's a good example of like how being afraid to take a loss can hurt you in the long run, because let's say maybe you were right this one time and this does happen and you didn't short into this, but let's say that, most times it does happen, right? In my experience, most times this does happen. If we're bearish in a range and we've had all this already, we've taken out liquidity into fair value gaps or order blocks up here, and we expand down, most of the time you're going for that low. Of course, no problem. That I know exactly like what you're thinking too, because I used to do that. I used to like, fuck, okay, we're in an order block long. And then it's like, what'll happen usually is like you literally like rationalize why you should long here, and then you get in a long and you're gonna target here, and maybe the order block does long into a premium, and then it just shits on you. That's what happens a lot, or used to happen to me. And then you realize, you're like, damn, what the fuck did I just do? Like, I had a full plan and I psyched myself out of it. But again, that just comes from, most of the time, inadvertently, the fear of taking a loss. Because like, if you're not afraid to take a loss, then why are you switching your bias? And that's where it comes back to like psychological things with smart money concepts, is it gives this esoteric, like, be all end all vibe where you think that it has to be right because it is so precise that you feel like you have to be right almost. It's just, I don't know why, but it just kind of like implants that into your brain. So I know exactly how that is. It's kind of like why I teach the way I do, because I know the problems I used to have. And the reason those problems is because the way ICT teaches things. And a lot of people would hate on the way I say. I mean, I'll respect the dude for coming up with stuff, but that's the reason for a lot of people's problems, is because of the marketing behind ICT. The whole, I can do this, but you can't do this, all that shit. But it's really just overcomplicating things, so you always feel like you have to be dependent on something. Yeah, somebody asked another great question. This would be the same but inverted if the market is bullish. Literally everything is. So think of it like a number. We're playing a numbers game with trading. All numbers have an inverse. That's the way I always run. Like any example I do bearish will work the exact same bullish. And to be a good trader, you have to not look at bullish or bearish any different. That's why you get the people who are only good when things are bullish, or they're only good when things are bearish, and they just are trying to short the entire time the market's in a whole bull run, and then finally it crashes and say, oh, told you. Or the people that, only make money in bull runs. But again, you have to look at the market from a perspective that you're a trader, and Bullish is the same as bearish. It's just where the fuck are we going and how am I going to participate? In fact, said, hearing you say, not every trader is going to be right. Help me out. And yeah, it's a thing, bro. Like, trading isn't about, like, success in trading isn't going to come from being right all the time. It's going to come from getting really good at losing and being wrong. Because, like, think about it. For one, you lose when you learn when you lose. Learning is what you have to do in order to make money, right? For two, if you learn how to lose, you won't get tilted. I'd say a big culprit that causes failure in traders that are intermediate, meaning like they understand what's going on and they understand what to do, but then they just keep fucking up on their own, it's getting tilted. So like they do really good, they have a 2 winning streak, they lose a trade, and now they're petrified. And they start fucking up, right? Again, that comes from not being a good loser. And a lot of people will be like, what do you mean? Like, you can't, like, losing isn't how you make money. And it's like, no, it's not. But successful trading is how you make money. And successful trading does not necessarily mean you win more than you lose. It means you know how to lose and you know how to win. Yeah, exactly. Knowing why you lost is way better than being mad that you lost. Like, I take losses all the time. Like, for instance, I took a loss the other day. I posted it in chat. It was somewhere. What was it? This day? Thursday, I think. Where was it? Oh, wait, no, I'm way early. I was like, this doesn't look familiar. I think it was somewhere up in this region. Yeah, I think I wanted to say I shorted. It was right in one of these areas, or I know it was somewhere around here. I don't know why the executions aren't showing, because I have them marked to show. It was glitching because I was trying to show you guys, but I did post them in stock chat, and we went over it on the stream on Thursday. So if you're like really interested in that, you can go watch the stream, and it will show exactly what I'm talking about. But somewhere in here, I took a loss, but I reversed it immediately, and I was like, okay, no, you're wrong. I'm not gonna sit there and like, no, it has to go. It has to go my way. I'm gonna hold it. I'm like, no, I'm like, fuck, you just fucked up. Take on the chin, move on, you know? So Hi asked, how and when to use liquidity as a point of interest? So do I need any price delivery rate like order block or fair value gap to be tapped? So in my book, I classify liquidity pool the same thing as an order block or fair value gap. But when they're paired together, it's just like confluences. So like before I traded smart money concepts, I would like require multiple confluences. So for instance, when I trade harmonics, I also had an algorithm called Omni. Some of you guys will remember that. A lot of you guys won't. But so basically I looked at like, okay, well, if I'm in the lower Omni bands and I have a harmonic, like that's 2 confluences all go long. So smart money concepts tries to separate itself from everything else, but in the end of the day, you can still use some of the same formulas. Like, okay, if I have 2 confluences being, maybe I have an order block right here, and maybe I have equal lows right here. If you take that out, that's 2 confluences. Now, how do you get 3? A confirmation entry. Boom. It's the same ideology. But again, liquidity pools and order blocks to me are both points of interest, but I like combining them. Again, multiple confluences are going to give you higher probability setups. Missed the first half hour? Yes, it's recorded and will be posted to YouTube. No question stupid, and you could only be bearish in a market with option trading. No, you could be bullish or bearish trading options. There's calls and puts. So like for instance, like if you're trying to bullish, you'd look for calls. I'd recommend doing some research because options can fuck you up pretty nicely if you don't understand them. Do I think that a situation with SIVB will affect the market? Yeah, absolutely, for sure. It's already affected the market. What's my perspective on it? I mean, I think that, I mean, we already had a massive fucking dump. I haven't even looked at Bitcoin. I know that fucking, what's it called, been going crazy. Um, but again, look at, like, when I look at Bitcoin, I see, okay, monthly fair value gap, order block, weekly balanced price range. So to me, I pay attention to it. I'm not gonna sit here and say like, oh, like that means nothing, like TA only. Yeah, the 13th largest bank in the world collapsing. Yeah, for sure, you're gonna see something happen. But I also look at it like, okay, I mean, what does this look like to you? Does that look like a long? Kind of does to me. So coming in this new week, I want to see the 4 hour get a nice bullish price action. So ideally, what I'd like to see, because I haven't really looked at this till now, come up here, take that out, take out lows, and then start to get that price action in the 4 hour. And then it's like, I think we can make new highs. Again, people call me crazy, but that until now, well, I'm not going to do that yet because right now we're bearish as fuck. So if anything, I'd be looking to a short end of this low right now, and I'd be looking for it above this high in that fair value gap. But that's kind of like where I see on what I see on Bitcoin. And if you're talking about the regular markets, I will say Nasdaq and stuff does not look too hot until we take. I really like this low. If we take out that low into this area, this daily order block right there, I think we could start to get maybe some more upside. But again, just don't try to forecast too much, just react. High gold tap sweep into the weekly order block at 1960 and displacement to the downside. I can say the overall weekly draw on liquidity is 1783. Hold on. I think gold looks amazing, in my opinion. I won't lie to you. But the reason for that is the weekly breaker right here. And then I took out all the stops from like the last 3 years and clear draw on liquidity to the upside. So I think gold's gonna move up. That's just me. But I could see maybe taking out that. That's as far to me on gold. That's all I need. 4 hours pretty bullish. I'd be looking for maybe some kind of retracement whenever you get it, and then I'd look to go long. I think Playboy actually got people in like gold swings, like the option, or yeah, like the stock, GLD or the fund. I don't know what it is, if it's a stock or what. Yeah, y'all killed gold. Yeah, I need to actually pay attention to this. To be honest, it's been clean. I keep saying that, but I just get so far. I just really like trading NAS and ES. I said fuck that breaker. Yeah, I mean overall you got bullish structure right here. You could even look and so this is a situation where if we just tap down into this without like a creating new structure, I would just look for more longs in that fair value gap. Because again, maybe under this low, because you took out this high with displacement with that fair value gap. So like that fair value gap that caused the break, right? So then you have liquidity inside of it. I would probably be looking for something like this if you get that. And then that's when you start to see, okay, now the market's going to create the new range. That's where you'd probably get an actual range. And then you can start looking for like swing trades. But that's a really good example of like immediate bias compared to like waiting for like a swing to end and then trying to pursue a new one. I probably should start watching gold. NZD CAD 4 hour. Yeah, sure. I'm probably going to hop off after this one. This looks like it went. I think the last time I looked at it was like down in this area. Just clean the whole chart off. I'd say it's probably going to take out these highs. Or at least that one. There you go. That's clean. That's what I would look for. And the reason for that is The bias overall in the daily would be bearish in the long run. You know, I guess your daily bias coming in the day would be bullish the next day, but I look at it like, okay, here's the most recent like displacement. We've got liquidity and a premium, that breaker block, part of this daily fair value gap. Also on the external level, you have a reason to come down because you're displacing the downside after, you know, coming up here and taking out. Looks like you took out this high. Did it take out this one too? Yeah, you took out sell side or sorry, buy side liquidity, and you have a massive expansion, so you have a reason to retrace. In my book, displacement down, leaving liquidity behind, take the liquidity, and look for more down. That's where I would be at. Nice, hell yeah. This is actually pretty fucking clean. I'll set an alarm for this. Did I get the wick? No, I didn't. Because I'll forget. Just make my trading view scream at me when that happens. Yeah, I like this setup actually. And also high, a little bit more on gold. Just the last session, and I talked about power of three. So accumulation, manipulation, distribution. That's my main, the reasoning behind this. Oh my god, check out general chat. Let's see. Oh my god. So I try to fucking save his ass. RIP. When did the price hit my low-hanging fruit in a bullish market, or when the price hit your low-hanging fruit in a bullish market, did not hit the overall DOL? The low time frame shows some downside movement. Will you still short it? Yeah, potentially. Like for instance, okay, let's say this. Like in this example, like my overall, what I think price is going to go to is all the way up here. But if I was a gold trader, like this is all I traded, and we came up into a fair value gap, and I saw the lower time frames giving displacement down, I'm just going to look for a discount of the most current impulse. So like, for instance, if I was a gold trader up here, and I saw something like this, a rate of highs and a shift down, I'm looking for shorts down to the equilibrium. ESPO3 played out in a daily chart this week. Oh, over here. I see what you're saying. I was looking like, I don't know, you said this week. I'm like looking like fucking 2 months ago. Yeah, that's perfect. Weekly power, or is it week? No, it's more, a little bit more. I see what you're saying though. This was up here, was even a lower time frame PO3 right there. There's so many too. Like once you really start to see it, it's everywhere, bro. Everywhere. Right, and then you can say, oh, okay, here's another one. And you just turn it there, or you can target it. It's like that's another thing too. If you're in a point of a power of three, like you can use the lower time frame power of threes, and then you can extend your targets to the higher time frame ones. On that note, guys, I'm going to hop off here. As always, I appreciate you all, and I will see you guys on Tuesday. Hopefully, this helped a lot of you guys. I think this is a pretty good one. So I'll start uploading it to the YouTube as soon as I get off here. But I'll see you guys on Tuesday. Peace.